So as you guys know, there's almost nothing redeemable on cable news anymore. I would much rather watch nonstop reruns of Jersey Shore than about 99% of what's on cable news. But CNBC does occasionally have some really interesting guests that come on, and occasionally those guests do not toe they don't toe the line. They actually tell some really interesting, hard-hitting truths. Here's this guy, Barry Sternlicht. He runs a huge real estate empire in America, and he's got some really poignant insight. I want to play this for you, but just kind of build up what he's talking about. Everybody right now is talking about the Fed. Raise rates, cut rates. Raise rates, cut rates. Inflation. You guys, bottom line, here's the deal. Right now, inflation is around 6.5, if that number is even to be believed, coming down from 7.7, and 8.2, as you can see down here. Rates are not even up there yet. Rates are going to have to get much higher than that, at least a full two percentage points higher. But everybody pretty much knows if we go that much higher, or even higher, which is probably even more necessary, the entire economy is going to be extremely illiquid, not much money moving around because people will be so tight on money. So I'm going to shut up. I'm just going to let you hear what this guy has to say, because truly the Fed is stuck between two areas. Either one, cut rates and let inflation go just up to the moon in our 1930s Germany, or two, increase rates so drastically and boom, you just empty out and bottom out the whole economy extremely quickly. So like I said, this guy here in about 3 minutes lays out some really high level but very layman explanation of kind of the situation we're in. And I just wanted you guys to be able to hear it.
Inflation has peaked. The biggest increase in the last month and has remained is the renter equivalent number in the data, which was 0.8 positive. In reality, that was 0.34 negative. The lag in the housing data is completely distorting inflation. And since rents are falling, market rents are falling month to month, not year over year, month to month. They're going this way. You will see a negative number there, and it will look like energy. It'll come all the way down. So inflation will come down. And people who talk about keep raising rates, I hear these guys on your morning show, I want to strangle them. Volcker didn't have a $32 trillion deficit. So here's the actual interest number. The federal government spent the following amount of money the last 4 years on interest expense. In 2019, $375 billion, then $345, then $352, and last year, $475 billion. So here were the average interest rates those years. They were 0.5 in 2020, 0.1 in 2021. That's the average. These are LIBOR, SOFR rates. In 22, they're 1.9%. This year, they'll be 4.5%, 5% of 30 trillion.
We'll be up to $1 trillion.
$1 trillion plus dollars
on interest.
And on interest, and that's so the budget that the White House put out has a $400 billion number that they didn't update it for today's interest rates. This is their November number out of the White House, which is where they put the 1.7 trillion, this fiscal spending. So what he faces, if he keeps going up, you have the Weimar Republic. He has to keep printing dollars to pay interest on the deficit. And you wind up printing and putting tremendous pressure now on all ends of the curve, right? So that will really slow the economy if the 10-year goes to 5, because this thing gets out of control. And who's going to buy our paper? And we've pissed off the Chinese. They're not going to be buying our paper. And most countries are pulling back to their borders now with deglobalization. The banks will support themselves. So he risks this if he keeps going, these academics in Washington. He risks the entire financial stability.
Just a quick side note, when he says who would buy our paper, the answer is anybody in the world would buy our paper, because while we might be a really stinky, dirty pair of shorts, we're the least stinky, least dirty pair of shorts in the whole dirty clothes pile. So that's true. Japan's worse off. England's worse off. You name it, nearly every single currency out there is worse off. You've got some currencies out there like Russia who are trying to go to a commodity-backed currency, but at the moment, everybody will buy us.
Ability of the system. You have the IMF and the World Bank telling you to stop raising rates, because what we do in our little holes in Washington with our Federal Reserve banks impacts the entire globe's economy. And it's not like it's strong in Europe. But so they can't afford higher rates.
But
They're worse off than we are.
Maybe this is what we need.
But it's coming your way.
Okay, so if rates go back down, then we'll say, hey, everything's fine.
So if he pulls this off, which he has a good shot of doing, actually, of having a soft landing, if he stops, he can have a mild recession is fine. I mean, it'll be fine. You don't destroy all these manufacturing jobs. We bring back, we onshore, we fix supply chains. He'll be good. I'd be bullish. If we keep this up, and obviously the political gridlock, and don't focus on things that matter in Washington, I would be.
If rates are higher, maybe we'll stop. That's what I'm saying. If we go right back to where you want to go, then we'll be like, okay, it's not $1 trillion in interest. We're back down to $300 billion in interest expense. But if we really are spending $1 trillion every year,
rates, but 2.5% low rate.
How do we finally? How can we spend on other things if our debt service is so high? And if it goes to $35 trillion,
we need a plan to reduce the long-term deficit. But here's.
That is the funniest thing. He finishes that little quote off right there. We need a plan to reduce. Whenever people talk about this with me, they say, "Gosh, we're stuck between a rock and a hard place, right? We either raise rates and crash the whole economy, or we cut rates and spiral out of control with hyperinflation." I always, remind people, hey, don't forget, there's that obvious, very easy, right in your face third option, which is cut spending massively, cut spending by 30%, cut spending by 10%. Just 10% would have a massive positive impact. You think that the Trump years of the stock market being up 20, 25% were great? If you cut spending by just 10%, the U.S. government, that would blow past those Trump years. So anyhow, it was just an interesting little, very poignant little exchange these guys had of just how upside down things are right now. But he's got that interesting point where, hey, you know what? We're gonna have a recession no matter what. We might even be in one right now. I would say we are, just because everybody's trying to debate what's the definition of a recession. But he's got an interesting point. He could pull off the soft landing, but it's gonna hurt. It's gonna drag out. So anyhow, I just wanted to keep you guys up to speed when some actual nugget of something interesting to digest comes across CNBC. Um, how are we, the United States, going to keep paying the interest on our debt and make up that deficit if we just keep spending, 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 printing, printing, printing? Well, just like you said, we just keep printing money, and that interest, and that was, again, just on the interest. That wasn't spending money on new random crap. That was just paying the interest to people. So if rates get raised, continue to raise, which the Fed has said, do not call our bluff, we're going to keep raising rates throughout 2023. That is going to seriously mess up the U.S. Treasury, the U.S. economy. But you know what? Time will tell. Anyhow, if you guys have anything else that's really awesome like this, is in the same vein, please comment down in the link. Put a comment with a link down in the comments. I always say that wrong. And let me know what you think. All right. Thanks.